The next financial collapse will probably not begin where the headlines tell you to look. It will not begin with the loudest politician. It will not begin with the most dramatic market crash. It will not begin with one country suddenly admitting it is broke. It will begin with something quieter. Trust leaves the currency, then trust leaves the bond market, then trust leaves the government. And when those three things happen together, the crisis is no longer a forecast. It is already moving. 7 countries are showing different versions of that same pattern: debt, currency pressure, reserve pressure, political denial, then a final choice between honest pain and dishonest money. That is the question behind this countdown. Not which country looks worse today, which country has the least room left to lie. There are 3 clocks running inside every debt crisis. The debt clock asks how much the government owes compared with what the country produces. Once debt moves above roughly 90% of GDP, every shock becomes harder to absorb. The reserve clock asks how long the country can defend the currency and pay for imports. If the market loses confidence, the political clock asks the most important question: when voters demand relief and creditors demand discipline, will leaders protect the currency, or will they protect themselves? When leaders protect themselves, the currency pays. Number 7 is Bangladesh. Bangladesh is the success story with the reserve problem. For 20 years, Bangladesh looked like one of globalization's winners. Millions left poverty, garment factories supplied the West. Growth was strong. The country became proof that manufacturing exports could still transform a poor economy. But a model can work and still be fragile. The pandemic hurt garment exports. The energy shock doubled the fuel bill. Higher U.S. rates strengthened the dollar. Suddenly, Bangladesh had to pay more for imported energy and dollar debt, while its export machine was under pressure. Foreign exchange reserves fell from roughly $46 billion to under $21 billion in around 18 months. That is not a small leak. That is the emergency fund being drained fast. The warning is not that Bangladesh collapses tomorrow. Its debt ratio is still far below the classic danger line. The warning is direction. A country with low debt and falling reserves still has room to borrow. But if that borrowing only buys time, the reserve crisis becomes the debt crisis. Number 6 is Egypt. Egypt is where finance touches food. Debt is above the danger line. The currency has been devalued repeatedly. IMF rescues have become part of the economic rhythm, but the real pressure point is bread. Egypt imports a huge amount of wheat. It has more than 100 million people. It controls the Suez Canal. It cannot treat food prices as a normal market issue because food prices in Egypt are political stability. If the government cuts subsidies, households feel the pain immediately. If it keeps subsidies, the budget suffers. If the currency weakens, imports get more expensive. If imports get more expensive, the subsidy bill grows. If the subsidy bill grows, borrowing grows. That is not a policy debate anymore. It is a trap. Egypt has creditors on one side and its own population on the other. Both are demanding something. The creditors want discipline. The population needs survival. Countries often break when both demands become impossible to satisfy at the same time. Number 5 is Pakistan. Pakistan is not just in a crisis. It is in a repeating crisis. More than 20 IMF programs since 1958 tell the story. Each one provides oxygen. None has rebuilt the lungs. Debt is near the 90% line. Reserves have fallen to terrifyingly low levels before. At one point, the country had less than a month of import coverage. Interest payments have consumed more than half of federal revenue. That is the number to remember. When a government spends more than half its revenue on interest, it is not investing in escape. It is financing the cage. Pakistan needs energy infrastructure, but debt service eats revenue. Because energy infrastructure is weak, the country imports fuel. When fuel prices rise, the government subsidizes to prevent social explosion. The subsidy becomes more debt. The debt becomes more interest. The interest eats more revenue. That is a closed loop of decline. Pakistan still has partners. It still has rescue channels. It still has strategic importance. But strategy does not pay the import bill forever. Number 4 is Turkey. Turkey is the proof that modern countries can damage money quickly. It is a G20 economy. It has real industry, real banks, real exports, and real strategic weight. And still, the lira lost enormous value because monetary credibility was sacrificed. Inflation surged. The central bank did not defend credibility early enough because politics pushed policy in the wrong direction. The idea that lower interest rates would cure inflation collided with reality. Markets sold the currency, prices rose, savers lost purchasing power. Money is confidence wearing a national symbol. Once people believe leaders will sacrifice the currency for political comfort, the currency becomes the escape valve. People buy dollars, gold, property, anything that is not the promise being weakened. Turkey has since moved back toward more serious monetary policy. Rates went higher. Inflation came down from the worst levels, but credibility is slow to return. Bad decisions compound faster than good decisions repair them. Number 3 is Argentina. Argentina is the crisis people have already learned to live around. 9 sovereign defaults, frozen deposits, broken currency, promises inflation as a recurring fact of life, a population that often trusts dollars more than its own money because history taught them to. The 2001 crisis is the lesson for years. The peso was tied to the dollar, the peg made people feel safe, but the fiscal discipline required to defend that peg did not hold. Deficits continued, debt rose, the IMF demanded cuts, social pain grew, politics froze, then the promise broke, bank accounts were frozen, dollar deposits were converted into pesos, official exchange rates did not match real exchange rates. Ordinary savers lost value, not because they made a bad trade, but because the government changed the rules. That is the nightmare version of sovereign crisis, not a recession, a rule change. Today, Argentina is trying to force discipline back into the system through spending cuts, ministry closures, and fiscal surplus. It may work, but the pain is heavy and the timeline is long. A country can become so used to surviving collapse that it forgets how expensive survival has become. Number 2 is Japan. Japan is the rich country debt trap. Its debt to GDP is around 263%. In most countries, that number would already have caused panic. Japan survived because it owes most of the debt to itself. Domestic institutions own the bonds. The Bank of Japan can support the market. Pension funds, insurers, banks, and savers are all part of the same closed loop for a long time. That made Japan look almost immune. But immunity was really low interest rates. When rates are near zero, even a mountain of debt can sit quietly. When inflation appears, the mountain starts to move. If Japan raises rates to defend the yen and fight inflation, debt service becomes more expensive. If it keeps rates low, the yen weakens and purchasing power erodes. That is the bind. The system needs low rates to keep the debt manageable. The currency needs credibility to keep purchasing power stable. Those two needs are now in conflict. Japan may not fall suddenly, but that does not mean the debt is harmless. It means the adjustment may arrive through currency weakness, inflation, financial repression, or years of slow wealth transfer from savers to the state. That is still pain. It just does not look like a normal collapse. Number 1 is the United States. This is the one most people resist because it feels wrong to put the United States in a sovereign risk countdown. But feelings do not change arithmetic. The United States has the reserve currency. It has the deepest treasury market. It has the strongest military. It has the world. And the most important capital markets. It has technology, energy, institutions, and a level of financial privilege no other country has. That privilege is real, but it is not magic. U.S. debt is above the 90% danger line. Long-term projections move much higher. The government continues running large deficits. Interest payments now exceed defense spending. That line matters. Defense is the cost of maintaining power. Interest is the cost of carrying past promises. When interest becomes larger than defense, the past starts competing with the empire. The United States does not face a Pakistan-style import crisis. It does not face an Argentina-style weekend default. Its danger is different. It can keep borrowing because the world needs dollars. That gives it more time than anyone else. But the more it uses that privilege, the more the system depends on everyone continuing to believe the privilege is permanent. If foreign buyers demand higher yields, interest costs rise. If interest costs rise, deficits widen. If deficits widen, the government borrows more. If it borrows more, the market demands more compensation. That is how the loop begins. The United States is number 1, not because it is the first to collapse tomorrow. It is number 1 because it is the center. If confidence weakens there, the pressure does not stay there. It moves through the entire world. Dollar debt becomes harder to service. Emerging currencies weaken. Commodity importers suffer. Global rates rise. Weak countries that were already close to the edge move closer. That is the hidden danger. The first country to fall may be Pakistan. It may be Egypt. Argentina could break again if reform fails. Bangladesh could slide deeper if reserves keep draining. Japan could shock the bond market if the closed loop cracks. But the country that matters most is the one that makes every other crisis more expensive. That is the United States. The lesson is simple. Do not watch only the countries that already look broken. Watch the countries that still have credibility left to lose. A currency crisis is not just about money getting weaker. It is about trust being repriced. A debt crisis is not just about numbers getting bigger. It is about choices getting smaller. The closer a government gets to the point where every option is bad, the more likely it becomes that leaders choose the option that buys time. That option is usually inflation. That option is usually currency weakness. That option usually punishes savers before they understand what happened. The countdown is not a prophecy. It is a warning system. Bangladesh tells you to watch reserves. Egypt tells you to watch food. Pakistan tells you to watch interest payments. Turkey tells you to watch central bank independence. Argentina tells you to watch deposit rules. Japan tells you to watch the bond market. The United States tells you to watch the dollar. The country that falls first will be the one where these clocks strike together: debt, reserves, politics. When those three line up, the story changes fast. And by the time the mainstream financial media finally calls it a crisis, the people who understood the pattern will already have moved.